warm welcome, everyone, to another installment of the Energy webinar series. This one is called LNG Market, The Road to Recovery. It's supported by the Al-Attiyah Foundation in partnership with Refinitiv. My name is Axel Threlfall. I'm editor-at-large for Reuters, based out of London, and thrilled to be hosting another of these sessions. As I'm sure most of you are aware, the Al-Attiyah Foundation is an independent think tank that provides robust and practical knowledge on global energy and sustainable development topics. Now, before we start, a few little bits of housekeeping. For any technical issues, click on the chat bubble, tell us what the issue is, and my colleague Johanna will assist you. We welcome your questions. To pose one, do click on the Q&A tab and direct it to me, the presenter, and I'll try and get to that question. And during the session, we are going to throw out 2 or 3 polling questions. They're going to appear on your screen. You'll get about 30 seconds to respond to those, so we'll get a sense of where you're coming from as well. Just a little tiny bit of context from me. It's very hard to get away from the US election right now, of course, tighter than most people thought. The idea of a protracted court battle clearly not making the markets happy this morning. I'm sure most of you know the LNG context well enough, in particular just how turbulent the past 6 months have been, so I won't make too much of a scene setting there. While global demand is forecast to drop by about, I think, 3% for 2020 as a whole, it is expected to make a recovery, some saying a pretty robust recovery, and we are already seeing that happening in places. And despite a bleak picture on plant approvals and export projects, we're also starting to see some movement there too, as lockdowns are lifted slowly. No doubt we'll talk about that over the next hour as well. That is enough from me. There is plenty for us and our panel to talk about. Let me introduce them. Giles Farrar is Director of Head and Gas and LNG Asset Research at Wood Mackenzie. Jan Bruhl is Senior Consultant, LNG and Natural Gas Advisors, Poten & Partners. Luke Cottle, LNG Analyst, EMEA for S&P Global Platts Analytics, and Pat Roberts, Managing Director, LNG Worldwide Limited. A warm welcome to all of you. Look, just to kick things off, I wonder if I could hear a few words from each of you, just a couple of minutes, some headline thoughts, if you like, on where you think we are now, how temporary you think the current situation might be, given the hit to production and the likelihood that demand will be playing catch up, if indeed that's what you think. Pat, let's start with you.
Okay. Well, obviously, there's been a big impact to LNG. We've seen knocks to the volume and also to the margins versus the original plan for 2020. We estimate that despite all of this, we might end up higher for the year in terms of overall sales, but much lower margins. We've seen a lot of new capacity start up, but we've also seen capacity shut in the US. I estimate that probably over $100 billion of expected investments in LNG, such as the Rovuma project in Mozambique, projects in North America, projects in Russia, and importantly, projects in Qatar, they seem to have been deferred. I think the Qataris are still very upbeat about pushing through with their 49 million tonne expansions. But overall, I think the mood in the industry is that we've been fairly resilient, but there is a call on margins, and going forward, the whole route out of COVID and how demand recovery may happen is still a question.
All right, Pat, thanks very much. Giles, same to you. Higher sales, lower margins, is that the general picture over the next at least 6 months?
Yeah, I think the market outlook is right. We will see more LNG this year, as Pat said. I think what's been interesting is that overall gas demand has held up much better than oil demand in light of the pandemic. Obviously, there's people are still in their homes, still burning gas. I think what we mustn't forget is that an extent market oversupply this year was almost inevitable anyway. So what you've seen is that COVID has made an already bad market situation worse. And I echo what Pat said about resilience in the market. So LNG demand this year in Asia is actually growing more strongly than it did last year. That's because lower priced LNG has outcompeted pipeline gas in some markets. It's displaced coal in other markets. And that's quite encouraging when we think about a resilience perspective. Now, as we look forward, we think we're going to continue in oversupply for at least the next year or so. The market has rallied recently, but we think that that's likely to be quite short-lived. But as we start going beyond the next couple of years, we think we're going to be returning to a tight market, and that's because you're seeing a slowdown in growth on new supply. I think long-term, the outlook for LNG demand is robust, right? So 4% growth in LNG in the long term. And that's quite important when you compare that with oil or even overall gas demand. LNG is a strong commodity. And what you're seeing is that even though some of the big IOCs are concerned about the energy transition and how they position, I think you're still seeing them commit to LNG. Total in recent investor presentations was quite strong on this. Shell has been strong on this as well. So LNG is still a market where there's a lot of interest, although people are increasingly considering how the energy transition is affecting it.
All right, great. Giles, thank you. Jan, to you, and you know, on the back of what Giles has said, yes, it seems like those the big oil majors, the big players, are going to be the beneficiaries further down the line. Are you 4% long term is what Giles said? What's your thought, Jan?
Yeah, we also see that LNG demand is certainly going to grow in the longer term, and I'd echo the comments earlier that we've seen. This was a predictable oversupply situation made much worse by COVID. Obviously, COVID is not affecting gas demand to the extent that it's affecting oil demand. LNG has always been quite cyclical in terms of the investment cycle, and we were seeing the postponements of the FIDs. We see that those will mean that there's going to be a tighter market in about 3 or 4 years' time. Some of the new FIDs will be too late to catch up with the potential demand growth to them. But obviously, this is all depends on what happens with COVID-19. Longer term, LNG is also robust in terms of the energy transition, in terms of the way that the demand will grow.
Okay. Jan, thank you. And just a final sort of headline thought, if you like, from you, Luke, as well. The resilience, the sort of 3-4% long term, cancelled, delayed FIDs, demand playing catch up. I mean, that seems to be the general picture now. LNG positioned to be a bridge fuel in the energy transition. We're all singing from the same hymn sheet here, right?
Yeah, I think so very much. I think it's been an incredibly turbulent 12 months or so for the LNG market. As my colleagues spoke to, we came into the year in a state of existing oversupply, and it took an additional hammer blow from the coronavirus pandemic and what that did to downstream demand. We saw those record low prices in Q2 and convergence of prices across all 3 major hubs. And really, there was some evidence for the first time of an efficient, well-functioning global gas market. We saw this strong supply-side response, and we are now moving into what is seemingly a period of price recovery, albeit, as my fellow panelists spoke to, it is not a smooth sailing one. While 2020 likely represents a bottom for global gas prices in this kind of cycle, we do think it remains a challenging environment. 2021 certainly still looks one where we will still see oversupply, and prices remain relatively tight in terms of interbasin spreads. But going forward, then, we do see the impetus from a slowdown in new liquefaction capacity and continued demand growth in the Asia Pacific help to tighten the global energy markets and lift prices.
Okay, very good. Look, thanks to all of you for kicking us off like that. As I said, it seems to me we are all singing from the same hymn sheet. Let's do the first poll here. Get us what those feel, and then we can get your reaction to that as well. This is the first poll, so it is a sort of, based on what you've just said, a shorter term bit. In which area should LNG players focus their efforts during the coming months? Capital efficiency, optimization, upstream optimization, and advanced analytics. You've got about 30 seconds to have a crack at that, and we will then come to, we'll put the results up and have a little chat about that. Just in the meantime, though, look, I mentioned the US election. We can't get away from this this topic. And I'm, clearly it's too close to call as well. But Luke, let me just get a quick comment from you. What would a Biden administration mean for US and global LNG?
Well, I think it's a mixed picture when you look on both sides of the coin, really. I think a Biden administration would probably mean more stringent upstream regulations on upstream production. Think about reinstating some of the methane regulations that the Trump committee has rolled back. And in ways, this provides both positives and negatives. I mean, we have seen recently the challenges that US LNG has had in signing long-term supply deals, in part because of the upstream carbon footprint of its emissions. We've recently seen Engie pull back on a deal because of pressure from the French government about the upstream carbon footprint. At the same time, what will it mean for US-China relations? Will we see the tariff on LNG dropped or reduced in the Biden administration? That could be supportive for long-term deals. So it's a mixed picture.
Yeah, and we'll come on to exports to China from US and from Australia in just a moment. Have we got? I will ask others their views on a possible Biden presidency and the impacts in just a second. But have we got the results of that poll question? Maybe we can put that up. There you go. So we've got an even 26% for capital efficiency and downstream market development. Digital and advanced analytics comes in with 9%. Pat, does that surprise you?
I think how you vote on this depends on where you sit in the LNG business. If we ask Qatar Petroleum to vote in this, I think they would say this is a real opportunity to grow the market and really go into, creating demand security. If you go to an IOC, capital efficiency, use of capex and opex is critical. So it really depends on where you sit here as to how you answer this one.
Yeah, and Giles, I don't know if you want to say anything on this. Should we be surprised that digital has such a low scoring on this?
No, I mean I'd echo Pat's points here. It's your focus through this period is going to depend on your place in the market. I mean, the digital and advanced analytics, I mean, that's something that we in our business are looking at very closely, because obviously as the prevalence of data comes through and data becomes much more live, much more real time, and there's other ways to analyze the market. As the market liberalizes, traders are going to be paying a lot of attention to this, but it depends where you are in the space.
Yeah, I agree, absolutely. I mean, I think the digital and advanced analytics is people are probably more focused, especially the big companies, capital efficiency and downstream market development. Those for me would be the most important ones. But right now, actually, the niche players, the traders, can look at at deals and there's a lot of value that is being lost in the way that LNG is being traded at the moment. And if you're really looking at the way that you can do your options and the way you can manage your positions in the market, both on the supply and the purchase side, then you can there's a lot of opportunity there. It's something that maybe people are missing right now. They're not nimble enough.
I think what Luke said on this earlier was quite interesting in terms of the way that the three major price indices interconnected, and we're looking at a truly functioning global gas market now. So what we're seeing, especially amongst our clients, is increasing questions on if you're a North America upstream player or a North America pipeline player, you're now actually interested in what is happening in the Pacific market. You're trying to understand the interaction between Russian flows, coal to gas switching, and LNG imports in the European market, because it's actually having a direct impact on the Henry Hub forward curve. And so because of that, this focus on advanced analytics is becoming more prevalent within the trading space. So it is something that everybody is kind of looking to get ahead on.
Yeah, can I just chip in with one other point? Is that my observation here is that we've spent a lot of money as an industry on safety and using sort of IT and technology to help in the whole supply chain. But quite rightly, as other panelists have said here, in the trading space, we are now sort of accelerating our trading. And so more cargoes are being traded and retraded and diverted and stored. And those analytics really have perhaps not been needed in the past, but they're needed more than ever now. And so I see particular players really accelerating their move into digitalization, analytics, and a community-wide interaction for trading rather than using emails and WhatsApp as they do at the moment.
Yeah. Okay. Great. Thank you to all of you for that. Luke, I want to come back to the US. I mean, I've talked a little bit about the response to a Biden victory, if indeed that is what we see. How do you expect US exports, LNG exports, to perform over the coming 12 months after the curtailments we've seen recently?
Yeah, it's a very interesting question. I mean, US LNG exports have been the biggest supply side response we've seen globally in an attempt to balance the global gas markets as we drop to these record low prices in this extreme state of oversupply we've seen in the summer just gone. And as we look forward to the coming 12 months, I mean, we have seen recently the price recovery on the prompt contracts as we move into the stronger winter demand months. That has opened back up netbacks for US Gulf Coast producers. And with that, we are finally seeing US LNG exports recover to nearly nameplate capacity. I think this week we're seeing US LNG exports above 10 BCF per day for the first time. So really this winter, we are seeing a recovery in US LNG exports. But the story next summer becomes a challenging one again, because what we have to remember is that we have all of this global supply which turned down in the summer of 2020 in response to record low prices. That includes Russian pipeline supply, Norwegian pipeline supply into Europe, and US LNG exports. And that's all going to look to come back into the market as we move into a higher pricing environment. And with that, we have over 150 MCM per day of additional US capacity, which is either unused or is being constructed by the time we get to next summer. And that is a massive amount of supply to ask the market to absorb. And that is really going to mean we are once again next summer looking at a state of oversupply. And with that, we do expect to see convergence of global gas prices and also a likely situation where we see further US curtailments. Now, the one big difference I want to point to here is when we compare summer of 20 to the summer of 21, is there is a very different story emerging with Henry Hub. Because Henry Hub this year just gone has been very oversupplied. We've seen prices at record lows, like the rest of the global gas hubs, as we saw US shut-ins. However, next summer, we're talking about a much more bullish story on the Henry Hub when we look at the current market prices. And the reason for this is because we've seen a substantial drop in associated gas production in the US on the back of this oil price crash. And that is going to mean we will see convergence of prices once again next summer and likely US curtailments, but it's likely to be at a higher floor because Henry Hub is providing a higher floor for the market.
Yeah. Okay. Can I just bring either Jan or Giles in on a part of this, and that is, quite specifically on US-China tensions and the extent to which US exports to China will be impacted. How does that play into the overall picture here, Giles?
I'm not sure that that's a major issue here. I think what you'll see is that the market will optimize around the impact of those tariffs within the market. We haven't seen it adding a lot to the market, maybe a few cents on the margin. So I don't see that as being a major issue. I'd agree with Luke on this point around Henry Hub being higher and setting a higher floor price for the global market. Our view is that we could see some underutilization of US facilities next year, but we're not expecting it to be at the same level as this year. And the other point, which I think is interesting with the US and also the wider market, is particularly with the US, is we've seen the impact of hurricanes. We've had a particularly active hurricane season this year, and we've seen how that has impacted supply in the market as it started recovering, and that uncertainty around supply in the market is going to kind of become a factor in hurricane season going forward. So there's just a kind of interesting little thing happening that, well, not a little thing, but an interesting little fillip in the market that we're going to have to pay attention to going forward.
All right, Giles. Jan, we talked a little bit. Well, we heard from some of you in your opening gambit a little bit about Asian demand recovery. What is the outlook there for you? And do you see? And of course, the coronavirus is a big unknown here, and the extent to which this is going to continue impacting the market. But what do you see for Asia demand recovery and further impacts from COVID uncertainty?
Well, Asian demand is more than 2/3 of the LNG market. LNG growth is going to be centered in Southeast Asian countries, Southern Asia, and China, obviously. And we're seeing that the major Far Eastern Asian countries are reacting to COVID probably slightly better than much of the Western countries, and the demand is not being affected as much. Obviously, the coming winter will sort of highlight the response and what really happens. But yeah, we're quite confident that the demand in Asia is going to be going to continue to grow.
Okay.
Driven by countries like India and China.
Yeah, go ahead, Gus.
I think what we're watching very closely in Asia is policy. So you've seen the South Korean administration introduce measures to limit coal-fired capacity, particularly older coal-fired capacity, through the last couple of summers to support air quality. You have also seen the Japan government announce a review of coal retiral policy. And you've seen India looking at a clean air policy, which hasn't yet been implemented. But what that does is that kind of raises the prospect for gas to kind of step in and meet some of that demand. Yep. At the same time, what we are also watching is whether you start seeing any kind of carbon taxing being introduced, particularly in the more advanced economies, and how that will play into the gas picture as well. It's a positive story for gas, but as the energy transition gains momentum, it will also start to become a story where gas is being watched very closely as well, as we're starting to see with the European market.
Yeah, and Pat, let me get your thoughts on that overall as well. And Giles mentions Korea, Japan, India. I mean, with a layperson's hat on here, just looking at some of the numbers recently out of India and the demand picture there, for now at least, it looks pretty robust to me.
Okay, I think that Asia is a term used for several markets, and really the market to watch here that is absolutely pivotal for the global LNG business for me is China. China, I think, has got a centralized government policy that it can choose to enact. So when it decides that it is going to go for gas, it goes for gas. Some of the other markets go for gas with qualifications that the price is right and that all the commercial terms are right. So I think China has the ability to move the dot in global LNG, very convincingly. And I think quite a few of us believe that China could easily grow to be a 100 million ton LNG market by 2030. and the signs coming from government is that, they will support gas. Mind you, it's always gas by pipeline gas or LNG, so we don't have an open goal. But in several other markets in the Indian subcontinent, in New Asia, there's a lot of qualifications of how quickly gas will grow. And of course, it's price sensitive as well. So that's my sort of outlook on it. We depend more and more on China.
Yeah, okay. I want to come to the second poll if we could, and I also want to tell the audience that do send questions through if you have questions for this panel. Here's the second poll. So have a crack at this. What will be the biggest driver of LNG demand in 2021? Increase in industrial consumption, environmentally driven coal to gas and oil to gas switching. Of course, we've talked about a few of these things already. Lower wholesale gas prices, accelerated demand in Asia. There you go. And recent investments in terminals and pipelines. So have a go at that. In the meantime, we talked about India. Yes, we've talked about the importance of China, but also Japan, India, Korea. Luke, let me start with you. To what extent could other countries follow India in terms of expanding its gas use beyond the power sector more rigorously? I mean, there seems to be very much a focus on that now.
Yeah, it's certainly, India has certainly been interesting seeing gas expand outside of the power sector in fertilizers, in the CNG sector. And I mean, it's not the sole location where we have seen expansion outside of the power sector. I think we look across Asia Pacific and there is potential both in the power sector and the industrial sector, and probably to a lesser extent in the residential commercial sector. China is a fascinating example of where we've seen gas demand growth really in rescom and industrial. And as Pat talked to, what has really accelerated this has been a mixture of policy support and competitive pricing. First of all, we had the blue sky policy from the Chinese government, which really accelerated gas's use in the rescom sector. And we continue to see that policy support there. We've seen a draft government action plan this year calling for up to 7 million homes in the Beijing region to switch from coal to gas heating. So there's still that push in China to continue this clean air push, and that's a major factor. Yeah. What we also see is across this region is slow liberalization of markets, build out of infrastructure is supporting gas demand across Asia Pacific. It remains the growth engine for the global gas market. And I do think it's important when we speak to that, we do not just speak to power, because there is other growth sectors. And with the right mixture of competitive pricing and liberalization and policy support, we can see those sectors grow their use of gas demand.
Yeah. Okay. Look, here's the result of that second poll. And B, environmentally driven coal to gas and oil to gas switching, something we've talked about, comes out on top at 34%. Increase in industrial consumption 23%. I mean, I guess we shouldn't be surprised by that by that result. And I come back to this idea of LNG positioned as the bridge fuel, if you like, in the energy transition. Is that a fair way of putting it, Giles?
Yeah, I mean, I'm not sure that we would agree with the answer of that poll. I think actually you've seen a lot of coal to gas switching within the European market already being accommodated, and actually with LNG price quite high relative to oil in the big Asian markets, what that means is that LNG on contract, which makes up 80 or 90% of the market, is quite highly priced compared to coal. So while there is a policy push, actually on a price push perspective, particularly in the Asian market, it's not quite there. The point that I was going to make with regards to the Chinese market, which both Pat and Luke were talking about, and which I think is fascinating at the moment, is we have seen a real upscale in trucked LNG within the Chinese market. And this plays to the points that Luke was making about liberalization, in that presently the pipeline network in China is controlled just by the NOCs. That is changing, but that's taking time to work through. And so what you've seen is that LNG at lower prices has been able to be trucked much further inland than that LNG would typically reach, and been able to outcompete higher priced pipeline gas or gas controlled by the NOCs. And so you've seen that competition really emerging in the Chinese market. Trucked LNG demand in China, so this is LNG transported by truck rather than LNG used in trucks, which is another growing sector, was in excess of total Indian LNG demand for a few months this year. So it really is a kind of a rapidly expanding part of the market, and it's expanding in other parts of the world as well, markets like Brazil.
And let's talk, and you mentioned there, Giles, the use of gas as an environment-friendly transport fuel. Let's talk a little bit about Pat. How do you see the growth of that area? Will we see LNG respond to this increasing demand from the transport sector? How quickly can we see that gap being filled by the LNG supplies?
Yeah, I think that we will see growth in that sector, and I think that there's been a chicken and egg thing here about laying down infrastructure, for refueling. That has been obviously the key sort of sticking point, and then added to that, there's been the whole economics. But what I see is us sort of coming together now, where infrastructure is being laid down, there are more fueling stations, and I think the economics are becoming more compelling as well. So I do see it happening. I mean, just to give everyone on the line who's listening, China obviously leading the way. In 2018, they had something like 250,000 trucks and 100,000 buses running on LNG, and they had around 2,500 fueling stations. And they are committed to grow that. But just LNG for road transport was just around 7 million tonnes in 2018. And I think all of our views is that that's only on the increase. It's been slower to adopt in Europe, but again, in comparison, there's something like about 150 odd fueling stations there. But in the next 5 years, expect a big growth there too.
Mm-hmm. Yes, it's an interesting one, this, because we kind of think that there should be potential, but when we do, and it's quite rare that we actually do, but when we speak to those kind of haulage companies or those companies looking at it, they're kind of struggling to get their heads around it. It's the same with the shipping companies in the marine bunker sector.
Yeah.
And it's got a niche LNG, right? And that's the long haul road market. It's not, what you'll see is that in cities, institutions will switch to electric because you can charge that much quicker. But the efficiency of long haul electric driven trucks is far below that of diesel and LNG, and LNG is the only thing which might be able to compare with diesel, and that's where you're seeing the push. But it does require a lot of gas advocacy to make this a reality in some markets. Some markets it's taken off, as Pat was saying, but it's always been a kind of stop-start thing. And yes, we're optimistic, but how optimistic we can be, I think, is very much an open question.
And I think this really comes. Sorry, Axel. I think this really comes back to that story as well of what do we see on the policy side. This is sectors where the decisions made by government will have a large influence on what is the actual growth potential. Certainly, growth potential is large, but there is a large degree of uncertainty because the pace of the energy transition and the pace of government support for the variety of different options to meet transportation sector fuel use is a very important driver here. And that's why we see a range of forecasts for things such as LNG as a bunker fuel and LNG as a road transport fuel.
Okay, good. Look, but there are a couple of pieces I want to come to before we go to our final poll. And by the way, for the questions coming through, we will get to these, and I know there's a question on Qatar in particular, and then we will talk about the prospects for Qatar. I know Pat has got some stuff to say on that, and has already said some stuff on that already. But the other bits and pieces, Jan, let me start with you. Non-traditional market participants making their presence felt in this market, the way that's going to affect the global LNG market. Let's start with that. How big an impact could that have?
I think the traditional oil and gas companies will still be the major investors in the sort of projects that we're seeing. The large stranded gas resources in difficult to operate in countries and offshore. I think in terms of the other traders getting involved into projects, I think that's the thing that's happening in North America mainly. I would say that elsewhere, and that's where I've been personally involved in, is more going to be a continuation of the oil majors and the people with deep pockets.
Okay, and Patricia, what do you feel about this? And I guess what I'm talking about here again is with a layperson's hat on, this diversification into upstream projects as well as the downstream regasification and demand projects.
I personally think the game's moved on from new companies wanting to invest in upstream assets and the whole concept of security of supply. I think the game has much more moved to security of demand. And so if people are coming in to invest in infrastructure, I think you'll see them more likely to want to invest in the downstream import facilities and, trying to connect LNG to markets. And I think that, tomorrow's world is going to look, sort of quite complex to do that. I think you see companies like the Japanese utilities moving out of Japan and committing to help launch new infrastructure in Asia. You see companies like the traders being prepared to invest in FSRUs just to open market demand.
Yeah. Okay. And the question comes through, and Luke, maybe I can throw this at you. And it really asks about the natural gas trading, the extent to which you think it could really take off in China as it has in the US in terms of the scale and the liquidity. Could we see similar volumes, I guess, if you like, in China?
Yeah, I think we are, as we go towards more of a market that is spot exposed, and people have to manage the positions which are not supported by these long-term oil index contracts. We're moving towards a market which does increasingly have to look at hubs and hedging risk exposure on these hubs. I mean, at the moment, we largely see that isolated to Henry Hub and TTF, which remain by far the most liquid hubs globally. Growth in TTF has been particularly interesting from an LNG perspective. We see people increasingly taking a position on the European market if they're involved in the LNG industry. We see refreshed interest in European regasification capacity long-term because it gives you access to this liquid European market. In terms of Asia as a liquid market in developing a trading hub, well, the course of that path remains one which is hard to predict at the moment. Certainly the liquidity we see at the moment is on the JKM marker and the JKM derivatives. That is probably where most of the hedging is done right now and continues to grow. But it's by no means fixed, and we are seeing new markets pop up as well, and that does present potential, especially in China, which is a large, diverse market with various supply sources and a lot of demand, and that is often what we need to see a hub created.
Pat, can I just quickly, before we go to this final poll, get a few words from you on the models for financing export projects and the way they've been changing, and where you think we're headed with this now, because this, I guess, is another part of the shift that we're seeing.
Yes, we are. And I think we've all been banging the drum for a long time saying that project financing rules are quite rigid and they require long-term contracts and they want them indexed to known commodities that people can feel comfortable with. And the innovation over the last few years is large companies, IOCs and utilities, equity investing in their plants, where they put their have their equity share, but they market their own equity share. And so they don't need to have long-term contracts with third parties. And that equity model was looking quite good in a pre-COVID world. And not all of them had to go to project financing initially. They could take FID from their own balance sheets. This year, the rules are changing. But one of the bright spots, I think, even in a COVID-19 world, is we have seen the $15 billion financing of Mozambique LNG. And I was just talking about that at a Mozambique Gas Summit last week with SocGen. And they were saying there's still an active appetite from investors worldwide to invest in good LNG projects. And the export credit agencies still are a very big force in project financing, and they are expecting that to go forward. And very interestingly, SocGen said, that project financing and investors are looking now at the prospect of financing on the back of spot indexes, providing they're deep, liquid, transparent, and fungible, basically. So that is, I think, potentially a good game changer for us.
Okay. Anyone else want a quick word on the financing before we move on?
Yes. So I think there's a couple of points. I mean, I'd echo Pat's comments there. There is a concern around particularly some of the European commercial banks on their ability to continue supporting fossil fuel projects. So we have seen, I get muddled up into which of the European banking institutions is one, but one of the major European banking institutions has stopped funding fossil fuel projects onwards. I was part of the Flame conference a few weeks ago, and I spoke with a number of bankers at that virtual conference as well. And what you were seeing is that the ECG boards within banks now have increasing veto power over investments in fossil fuel projects, and this is becoming increasingly important. So there is a kind of question in terms of how long that liquidity is going to be there with regards to the European banks to continue supporting projects. I think what will be interesting is whether we see other financing institutions step in and kind of meet that need, and what kind of risk profiles they're prepared to take, or whether there needs to be an education process on deep and liquid markets and how viable they are again.
I think.
Yes.
Yeah, go ahead.
I just have one thing there. I think the other very notable point is the risk appetite of IOCs, particularly Western international oil companies, thanks to the likes of Shell, Total. We've seen over the last 12 months how challenging a market environment it has been across the commodity industry, and we've seen this pullback in capex expenditure. And certainly some of the Western IOCs, Shell, Total, BP, in light of the post-COVID world, are reevaluating their portfolios and what weight they want to give to natural gas, what weight they want to give to oil, and what weight they want to give to renewables. And one of the trends we're seeing that is a decreasing risk appetite from the likes of some of BP, Shell, Total to invest in these very long-term focused, very high capex LNG liquefaction projects. Certainly Shell have come out and be quite vocal and said they do not see much more growth in their LNG portfolio going forward in terms of new greenfield builds. So we see both some positives, as Pat talked to, some limitations, as Giles talked to, around European bank financing. We also need to bear in mind what is the risk appetite for the IOCs to finance off equity, because certainly in some cases we see that decreasing as well.
Yeah. Okay. Well, yeah. Go ahead.
Sorry, I think what you see in this environment is a flight to quality. So you're looking at faster payback period investments, and I'd echo Luke's points about questions around long-term IOC appetite for investment in LNG. But that is because if you're on a long greenfield investment, you're not going to get payback on your investment until post 2035 or something like that, because of the length of time it takes to recover that capital expenditure. So those higher cost greenfield projects in remote locations, there's a question of whether some of those ever get built now. There is long-term demand, but it's just who's going to have that investment profile. And what you're seeing is the low-cost break-even projects like Qatar, like Arctic Russia, are moving ahead.
But can I just say, I mean, I agree there's two sides to all of this in terms of, you know, sort of positive developments and sort of breaks and slowdowns. But if you do look at Qatar and the actual speed and scale of what they are proposing to do, which is a 49 million tonne per annum investment coming on stream from 2025, I think if they elect to take partners into this, I would expect the IOCs to look at this as a one-off positive opportunity for them to grow their portfolios. So again, I come back to the point that there is always sort of money around for a good project. And I think the Qatari business model has permed together, you know, means, motive and opportunity to take advantage of the world as it is now in order to really advance their projects, because they are low cost and they are market makers. They've taken lots of capacity out in Europe. They're developing more deals in China. They're attracting sort of good partnership opportunities. So I think that is enough to keep the business sustaining positively through the 20s.
Okay, and that I guess that to the person who wrote in prospects for Qatar, that's a response to that. The momentum is clearly there, right, in Qatar, and the oil majors will clearly take their investments seriously in projects in that region.
It is, as I said, the flight to quality. I think that really sort of ticks quite a lot of their boxes in terms of what they want in terms of long-term LNG presence.
Yeah. Okay, look, I'm wary of the time. I'm going to move us to the third poll, which is really throwing this forward. And we've touched on a number of these things, but here's the third one. The major challenge remaining on the horizon: decreasing role of gas in baseload power generation, electrification. We've talked about the rapid decline in the cost of battery technologies, which could challenge the role of gas as a peaking power generator, and pressure from new tech, such as green hydrogen. So have a go at that. And as you do, let me throw that general question, that same sort of polling question, out to our panelists. Jan, starting with you, which would you pick of the four here?
Yeah, I've picked A, because I guess that the other sectors are small in terms of volume for gas at the minute. Battery technologies, gas is peaking is important, and it'll be important for gas's future. But right now, where we're seeing is that gas is being hit in baseload generation by renewables, which will always push gas out. I think that in terms of the other ones, electrification, that comes back to gas anyway, because gas will potentially benefit in terms of producing the electricity for the electrification. But the one that stems from renewable energy sources is A, and that's really where gas is going to be hit the most.
Okay.
Some of these other sectors, it will remain.
Let's see if the viewers agree with that. Yeah, they do. A, 37%. We've got the lowest on electrification on B. Giles, to you, you know, and I guess this sort of brings all of this together, the extent to which LNG, or how LNG will operate against coal and carbon capture, batteries for grid support, hydrogen over the next 20, 30 years. You know, putting all of those three together, how big a challenge is that?
That's a pretty huge question in our business anyway. I mean, look, so I think on the point about gas in power, yes, gas is being hit by rising renewables penetration. But at the same time, gas is finding market share by displacing coal as coal retirals are moved forwards. And so you have this kind of shifting picture on the power side, which certainly will sustain gas and LNG demand through the 2020s and into the early 2030s. I think where we're getting quite interested, and indeed it's probably one of the hottest topics in the market, is on what we would say are the harder to decarbonize sectors, so the residential, the industrial market. And that is where hydrogen is becoming a very hot topic as we try and understand how the costs on that might evolve to make it competitive with other sources of energy in those markets. I think that's a picture that's still got some way to sort of evolve, but that's something that we're looking at quite closely, because there's a path with power that you can see, which is electrification, storage, so on. But the other sectors, residential, industrial, there's not that path there, and that's where hydrogen gets interesting.
Luke, how black a mark are methane emissions for gas?
I mean, it's a conversation that is gaining increasing focus, I think, is what is the upstream methane profiles of different gas producers. Certainly in Europe now, we see that methane emissions could be a significant hindrance to gas being part of the energy transition or a bridge fuel. The conversation in recent years has grown around increasing transparency around how much methane emissions do we see from different projects. And if you want to continue to compete into that European market and continue to find space, certainly methane is one of the big issues which the gas market has to tackle. That's going to be increasingly important as we see things like a carbon border tax in the European market. These methane emissions are going to be very important in that. There's probably less of a conversation in Asia right now. And I think the fascinating thing is we talk about two very different markets when we talk about the two demand markets for LNG. Europe is accelerating through the energy transition, and certainly there is pace in Asia as well. But the story in Asia is very different because we still see this top line energy demand growth. We're still talking about absolute energy demand growing in Asia. And within that space, coal versus gas competition is still very relevant. And as much as in Europe we talk about the role of hydrogen and the role of renewables going forward, in Asia the conversation is still as much about can gas displace coal in the future power stack and as part of the energy mix.
Yeah. Pat, these are all headwinds, of course. You know, whether we talk about the batteries for grid support, hydrogen, the methane issue, but looking out 30 years away from 2050, life of assets clearly it becomes an issue as well. You know, just some closing thoughts from you on where we'll be. Sort of, again, it's a big question to Giles' point, but sort of 10, 15 years down the road now for the LNG market.
I think we've got to be quite humble in terms of our forecasting. I mean, this year we've had more black swans than white swans affecting our business, and things like, you know, a step change in technology is always sort of out there as a wild card. I think that one of the really big distinctions here is that we can grow the LNG business and we can keep growing it, and we can keep growing it on sort of lower prices. So I don't think there's an issue about demand. I think volume is fairly easy to build. I think it's the value capture and sustaining value in the business that is going to be the issue. Displacing coal can be government driven on policy, but at the end of the day, the fight really is over price as well as carbon emissions. So LNG's best way of staying relevant is to clean up its own act in its own supply chain, which will incur some cost into the LNG supply chain, but at the same time, you know, actively go out to compete and displace coal wherever it can, and particularly supported by government. So a huge amount to chew over there in what I've just said, but I guess at the end of each day, I still am optimistic. and I'm positive that LNG has got quite a significant role to play over the next 20 years or so. But again, we've all got to be humble and know that there could be some wild cards out there.
Yeah. Jan, what do you think is the best way for LNG to stay relevant, to sustain its value, if you like, over the next 20 years?
I think I'd echo sort of what Pat said there. To remain cost effective and to remain competitive against coal, supported by the absolute need to reduce the carbon emissions in the growing economies, and that will be by displacing the coal burn there. Coal is we think the LNG, talking about the history or the future of LNG, coal should have no future really. Hydrogen in Europe, again, I'll just come back to that one actually, is that there is a potential for blue hydrogen there, which is from natural gas with carbon capture and storage. But I'd say that definitely the future is to replace coal in Asia.
Okay, and final, very quick thought from you, Giles, and you, Luke.
Okay, so look, I think market remains positive. Medium term, I'd say, for LNG. I'd echo the points about at low prices, LNG is very compelling, but cost of development is still quite high at the margin when you get out of those really strong low cost plays like Qatar and Russia. So I think it's going to continue to grow. It's going to continue to be exciting. I think we're going to see market shuffling around. I think we're going to see liberalization, and it's going to be fun and interesting to continue to be part of the space.
Continuing,
as I'm sure we'd all agree. But thank you for your questions.
It's a pleasure. Luke, let's get a final 20 seconds from you on this.
Yeah, I think as my colleagues have spoke to, there is plenty of opportunities for the LNG market, but there is also a number of hurdles and challenges as we move into the coming decades. I think price is a very important factor, and that competitiveness versus coal and alternative fuels, that is one of the reasons we see only the most competitive projects likely to move ahead. Competition is very important now. And of course, the other thing which we've talked about, things like sorting out their own supply chains, more transparency around upstream emissions and being cleaner is important, especially in the European market. And some of the points Gilles talked to, we also need to think about liberalization of markets and ensuring government policy support. They're going to be crucial in accelerating demand growth and keeping a healthy outlook for the LNG industry. But yeah, lots to look forward to, lots of interesting discussions to be had. And thank you for the invitation to join this discussion today. It's been very interesting.
Pleasure. Look, it's been great, all of you. Luke Cottle, thanks to you, to Giles Farrar, Jan Breuil and Pat Roberts. Really has been. We've touched on a lot of different bits and pieces. I found that really engaging. Thanks to everyone for watching as well and for sending in your questions. This was, of course, this series supported by the Al-Attiyah Foundation in partnership with Refinitiv. We hope you found the series useful. Again, thanks to our speakers today. We hope to see you all very soon. Many thanks.